Every single year, like clockwork, you go through the same painful ritual. You gather your W-2s, you sift through a pile of receipts, and you hand over a massive chunk of your hard-earned money to the government. You feel the sting of that tax bill, knowing that you worked hundreds of hours last year just to fund the system. Meanwhile, you read headlines about billionaires like Jeff Bezos or Elon Musk paying a lower tax rate than their secretaries, sometimes paying zero in federal income tax. And you ask yourself the question that burns in the back of every working person's mind. How is this possible? How are the wealthiest people on the planet, with more money than entire countries, legally avoiding the one thing that is supposed to be a certainty in life? Is it a secret loophole? Is it a corrupt system? The answer is yes to both, but it is not what you think. Most people believe the rich have an army of expensive accountants who use tricks that are unavailable to the rest of us. But the truth is, they are not just playing the tax game better than you, they are playing an entirely different game altogether. They operate under a secret playbook, a three-step financial strategy so powerful that it allows them to build generational wealth and live a life of luxury, all while paying little to nothing in taxes. It is a strategy known by the simple and slightly morbid name, buy, borrow, die. My name is John, this is the Penny Plan, and today I am pulling back the curtain on the single greatest wealth building and tax avoidance strategy ever created. I'm going to show you exactly how the ultra-rich use this method, and more importantly, how you can start using a version of this playbook today to legally reduce your tax bill and accelerate your journey to financial freedom. Before we break down the mechanics of buy, borrow, die, we have to understand the enemy. The enemy is not the IRS. The enemy is the fact that there are two completely different tax systems in this country, and you are, almost certainly, trapped in the wrong one. The first tax system is for the labor class. This is for the 99% of people who earn a W-2 paycheck. This system is designed for maximum extraction and compliance. It is a financial shearing pen for sheep. Think about how your money flows. You work, you earn a paycheck, and the government takes its cut first, before you even see the money. Federal taxes, state taxes, Social Security, Medicare, it is all gone before it hits your bank account. You are then forced to live, save, and invest with what is left over. You are taxed on your labor, and that is the highest taxed form of income there is. In this system, the more you work, the more you are punished with a higher tax bill. But there is a second tax system. This system is for the owner class, the capitalist class. This system is not designed for extraction, it is designed for incentives. It is a series of green lights and rewards for people who own assets. In this system, the flow of money is reversed. You get your money, you get to spend it, you get to invest it, and you pay taxes, if any, on what is left at the very end. The government doesn't want to shear these sheep. It wants to encourage them to grow their flock because they own the farm. This system rewards you for owning things that go up in value, things like stocks, real estate, and businesses. The stakes of being in the wrong system are your entire financial life. If you spend your whole career in the W-2 system, you will work for 40 years and hand over roughly 40% of your lifetime earnings to the government. You are the engine that funds the country. Meanwhile, the people in the owner class will use the tax code legally as a tool to build their wealth, paying a fraction of what you do. The goal is not to cheat the system. The goal is to graduate from the first system to the second. And the buy, borrow, die strategy is the graduation ceremony. It is the secret handshake that gets you into the club. It is the knowledge that separates the people who work for money from the people whose money works for them. And it starts with the first and most important step. Let's get into the mechanics. How does this three-step waltz with the tax code actually work? It is simpler and more brilliant than you can imagine. Step 1. Buy, the foundation of everything. The word buy here does not mean buying a new car, a luxury watch, or a bigger house. Those are liabilities. The rich don't buy liabilities, they acquire them through other means. The buy in this strategy refers to one thing and one thing only: buying appreciating assets. What is an appreciating asset? It is something that is likely to be worth more in the future than it is today. The two most common and accessible examples for us are a diversified portfolio of stocks, like an S&P 500 index fund, and income-producing real estate. This is the absolute bedrock of the entire strategy, and it is based on the single most important rule in the entire tax code. Unrealized capital gains are not taxed. Let me say that again, because this sentence is the key to the whole kingdom. Unrealized capital gains are not taxed. What does that mean? Let's say you take $10,000 and buy shares of an index fund. Over the next 5 years, the market does well and your $10,000 grows to $50,000. You have a $40,000 gain. How much tax do you owe on that gain? Zero. Absolutely nothing. Why? Because you haven't sold it. It is an unrealized gain. It is a paper gain. The government cannot tax you until you sell the asset and realize the gain. Now, compare this to your W-2 job. If you got a $40,000 bonus at work, how much would you actually take home? After taxes, maybe $25,000. You lose almost half of it instantly. But the investor who made $40,000 in the market pays nothing. This is the fundamental mindset shift. The rich do not focus on earning a high income. They focus on building a high net worth. Their goal is not to have a big paycheck. Their goal is to have a massive portfolio of assets that is constantly appreciating in value, tax-free. They are happy to be cash poor, but asset rich. While you are focused on your salary, they are focused on their balance sheet. And this one difference in focus explains almost the entire wealth gap. They are playing a game of accumulation, not a game of income. So they buy and they hold and they never ever sell. Step 2, borrow, the secret weapon. This is the part that blows most people's minds. If the rich never sell their assets, how do they pay for their lifestyle? How do they buy their mega yachts and their private jets? They don't use their money. They use the bank's money. They borrow against their assets. This is the most brilliant tax loophole in existence, because what is the one form of cash you can receive that is not taxable? A loan. A loan is not income. When you go to the bank and get a mortgage, the IRS doesn't send you a tax bill for the $300,000 the bank gave you. It is debt, not income. Here is how it works in practice for the ultra-wealthy. Let's say a billionaire owns $10 billion worth of stock in their own company. They want to buy a $200 million yacht. If they were to sell $200 million worth of stock, they would immediately face a massive capital gains tax bill, roughly 23.8% at the federal level. That is a $47 million tax bill. But they are smarter than that. Instead of selling, they go to a private bank like Goldman Sachs and they take out a loan using their stock portfolio as collateral. This is called a portfolio-backed loan or a securities-backed line of credit. The bank will happily lend them $200 million at a super low interest rate, maybe 2 or 3%, because the loan is secured by billions of dollars of stock. The billionaire gets $200 million in cash, tax-free. They buy the yacht. They pay a few million a year in interest, which is a tiny fraction of the $47 million in taxes they would have paid. They have successfully financed their lifestyle without selling a single share and without creating a taxable event. Now, you might be thinking, that's great for billionaires, but I don't own a tech company. But this tool is available to you too. If you have a brokerage account with $100,000 in it, you can take out a portfolio-backed loan. You could borrow $30,000 against your portfolio to use as a down payment on a rental property. That $30,000 is tax-free. You just used a core tactic of the wealthy to acquire another appreciating asset. Or let's say you have an unexpected medical bill. Instead of selling your stocks and paying capital gains tax, you could borrow against them to cover the bill and let your investments continue to grow untouched. This is the engine of wealth preservation. The rich live off of tax-free debt while their underlying assets continue to appreciate in value, generating more wealth that they can borrow against in the future. It is a perpetual motion machine of wealth creation. Step 3. Die. The ultimate tax loophole. This is the final and most morbidly brilliant piece of the puzzle. The question everyone asks is, don't they eventually have to pay back these loans? The answer is yes, but they don't. Their estate does. And this is where the tax code delivers its final gift to the wealthy. It is a rule called the stepped-up basis, and it is the single greatest loophole in the entire tax code, responsible for legally erasing trillions of dollars in taxable gains. Let's go back to our earlier example. You bought a stock for $10,000 and it grew to $50,000. You have a $40,000 unrealized gain. You lived off of loans against this portfolio your whole life. Now you die. You leave that $50,000 portfolio to your children. The moment you die, a magical thing happens. The cost basis of that stock is stepped up to its current market value. So for your children, the cost basis is no longer the $10,000 you paid for it. Their new cost basis is $50,000. What does this mean? It means your child can sell the entire portfolio the next day for $50,000, and the taxable gain is zero. The $40,000 of appreciation that your portfolio experienced during your entire lifetime is legally and permanently erased from existence. It will never be taxed. So what do the heirs do? They sell a small, tax-free portion of the inherited assets to pay off the loans their parents took out. The rest of the portfolio is theirs, free and clear, with no capital gains tax due. They have just inherited immense wealth, almost entirely tax-free. This is the full cycle of buy, borrow, die. You buy appreciating assets, you borrow against them to live your life tax-free, then you die, and the stepped-up basis erases the gains so your heirs can inherit the wealth tax-free and pay off your loans. It is the most perfect, elegant, and legally airtight tax avoidance strategy ever conceived. At this point, you are probably feeling a mixture of awe and outrage. You are thinking, this is insane. This is a system designed by the rich for the rich. It is a scam. And you are not entirely wrong. The stepped-up basis is a controversial topic for a reason. But here is the twist. You cannot change the rules of a game overnight. Complaining about the system will not make you richer, but learning to play the game by the same rules as the wealthy will. The biggest mistake you can make right now is to hear this information and decide that it is not for you. You might be thinking, I'm not a billionaire, so I can't do this. But you are wrong. You are already participating in a small-scale version of this, and you probably don't even realize it. Have you ever taken out a loan from your 401k? That is the borrow strategy. Have you ever taken out a home equity line of credit to pay for a renovation? That is borrowing against an appreciating asset. The real secret is not the specific financial products, it's the mindset. You have to stop thinking like a W-2 employee and start thinking like the CEO of your own life, which I call Me Incorporated. The CEO of a company doesn't focus on their salary. They focus on the company's balance sheet. They focus on increasing the company's assets and using debt strategically to grow. You have to do the same. Your W-2 job is not your identity. It is your seed capital. It is the funding for your real business, which is Me Incorporated. Your mission is to take as much of that seed capital as possible and use it to buy assets. You need to build your asset column. Every dollar you put into an S&P 500 index fund is a dollar that graduates from the W-2 tax system to the owner tax system. Every dollar of equity you build in a rental property is a dollar that is now working under a different set of rules. Your goal is to make the income from your assets eventually surpass the income from your labor. That is the moment you become free. The world is divided into two groups of people, those who understand how money and taxes really work, and everyone else. For most of your life, you have been in the second group. You have been playing a game where the rules were written to ensure you could never win. But today, you learned the secret. You learned the playbook. Buy, borrow, die is not just a strategy for billionaires. It is a mindset. It is a philosophy. It is a commitment to stop being a pawn in the financial system and start being a player. It starts small. It starts with your first $100 in an index fund. It starts with reading the tax code not as a burden, but as an instruction manual. It starts with shifting your focus from your next paycheck to your next asset. Do not let anger at the system paralyze you. Let it energize you. Let it motivate you to learn the rules so you can use them to your advantage. You don't have to be a billionaire to build generational wealth. You just have to stop thinking like a taxpayer and start thinking like an owner. If this video opened your eyes and made you question everything you thought you knew about taxes and wealth, do me a favor and hit that subscribe button and like this video so we can help more people learn the rules of the game. I'll see you in the next one.